Greetings, friends. Here we are. It's Friday, the 1st of July, and we have a 3D weekend. That's cool. Just ordered a new book on advanced option strategies. I hope I get it so I can do some reading over the weekend. So we finished out the quarter. We finished out the first half of the year. It was awful. Today the market is kind of flat. S&P is flat. Nasdaq's down slightly. So yeah, that's where we are. A couple of quick things before I go over the performance for the second quarter of the year. I want to take a look at this here chart. This is basically by sector the performance over the past 200 days. So you can see here, energy has been the leading sector. Staples, utilities, and healthcare all outperforming the other sectors. So if you take a look at what we have here, this is the market cycle, the orange, and then the blue is going to be the economic cycle. So you can see here energy, staples, healthcare, utilities. These are the sectors that are outperforming. So you kind of think we might be right around here where the market is in decline and the economic outlook is starting to roll over. And I think that's kind of a good synopsis of where we are. So as this market declines further, you would expect some money to rotate into financials, real estate, and eventually tech and consumer discretionary as we start coming out of, as we start bottoming in terms of the recession, and the market will start recovering before that because it's a leading indicator. So I thought this was real interesting. So clearly energy, staples, healthcare, utilities, we're definitely right here in the cycle, which is the market is in decline. We still have more to go, and the economic cycle is rolling over. So this makes a lot of sense to me, right, with the sectors. So that said, I don't think we're out of the woods yet with the market declines, and I certainly think the economy is rolling over. But I would say we're closer to maybe we're probably right around here. So we have some further decline, and then we should start the recovery process. And I'll be looking at financials, real estate, tech, consumer discretionary, and maybe some communication services as well. Industrials too might work. So I thought this chart was, or this graphic was interesting. You know, just going through some of my tweets here and the reading that I've been doing. You can see here the so bear market history as a guide. So this is peak to trough bear markets, and these are the duration in days. If you take an average of this, it comes out to be about 388 days. You can see here we're 164 days into this correction. So you know, we're about halfway there or so, which would make sense with the previous graphic right here. So we were estimating we were right here, you know, probably about halfway through, given where these sectors are, or the sectors that are outperforming. So yeah, I would say that we might be halfway, maybe a little bit more than halfway there. So definitely keep your downside bias in the portfolio, and let's ride this out. Here's one. You know, I get a whole bunch of different stats that I think are interesting. So according to this, this year has been an equity market meltdown for the record books. In real terms, you know, that's taking into account inflation. The S&P is having its worst year since 1872. 1872, for real? This was interesting too. So he wrote, the market is a discounting mechanism, which is why economic data tends to bottom after the stock market. On average, stocks bottom 116 days before the economy does. So that's kind of going back to what we were saying before. I think as the economy is rolling over, that doesn't necessarily mean that the market's going to go with it. It's a forward-looking mechanism. So the market will bottom before we see the bottom in the economic data. So if you have a 60-40 portfolio, 60% equity, 40% bonds, I'm assuming that's what that means. This is ranking as one of the worst years, or the worst year since 1976, if you have this diversified portfolio. That's harsh, 16%. So here he writes, we're we're going to have the worst start of the year since 1932. If you go back to 1932, there were 3 other times where the market started the year down more than 20%, and in each of the subsequent years, the market closed higher than it had ended that June. And he gives an example here of 1962. So here, the orange is where we are now, down here. Maybe we get a rip your face off rally going through the summer, but in the end, we might retest the lows again. So kind of go inside, kind of goes with what we're thinking. This is interesting. So the Atlanta Fed GDP now is pretty accurate in terms of just forecasting the forward GDP numbers. And right now they're estimating the next GDP announcement is going to be negative. So if that does happen, and if they're correct, we're in a technical recession, right? That's going to be 2 consecutive quarters with declining growth. So this recession may have started. A lot of folks out there are saying that's not the case, but me personally, the way the market's been acting, I would say, yeah, definitely, we're in a recession. So here we are. So this is for the first 124 days of trading. I'm assuming this is through midway through the year. You can see that we're ranking up here pretty bad compared to the other big drawdowns that we've seen in these other years. And you can see here from the midpoint of the year to the end of the year, the record is spotty, right? So there are some years where it actually bounced and rallied hard. There are some years that it fell further. I'm anticipating that we may not see these strong numbers for the second part of the year. We might be somewhere in here or a slight gain. 2008 was a major recession, 73, 74 recessionary period. 2002 was that long drawn out dot-com bust. So a spotty record. I really don't get much from this except to think that possibly this year, this 2022, these question marks here might actually be in the red. Now this one tells a different story. This time series going back to 1946, right? So here are the largest quarterly drops. So this is the quarter that just ended. This is what we're down. And you can see in the following quarter, which would be the July, August, and September quarter, the market actually did well with the exception of 08. And then in the next half and the next year, they're all green. So are we near the bottom? Possibly. But again, I'm not going to use economic stats and historical stats. I'm just going to watch the charts and try to trade accordingly. So a couple of weeks ago, the market had gained, I guess this is the S&P 500. So the S&P 500 had gained 6% in a week. I think the NASDAQ had gained like 10% that week. So higher than 12.5% on average 6 months later and 21.7% a year later. So these big moves in the market like we saw a couple of weeks ago have usually been followed by pretty stellar 3, 6, and 12-month performance. So we're down here. We had one on 318 and 527. So will these end up being green? I'm just going to keep the portfolio neutral, or as neutral as possible. I do have some upside exposure. I have some downside exposure, so I'm just going to try to trade accordingly. All right, so enough with that stuff. So here's where we are, or here's where we closed the quarter. We have a 51% upward bias in the portfolio. We have 38% downward bias and 11% neutral. So as you can see, I'm trying to keep this portfolio a little balanced. I might be maybe a little bit weighted to the upside, but as the days and weeks pass, I'm going to try to increase our downward exposure. So here we are for the month. So this is for the month of June. We had done 131 trades. We made $61,000 on about $650,000 that we had put at risk. So it's about a 9.5% return based upon the money that we had put at risk. Now, here, the month was funny because it started out, I had downward bias, and we had some really big sell-offs early in the month, and I was taking some rip-roaring profits. And then after that, I was exposed to the upside pretty dramatically, so I ended up losing a lot on that exposure. And then I eventually rebuilt it to a position where I needed to be. So I had 67 profitable trades and 64 unprofitable trades. So it's only 51% profitable, but the profit ratio is 1.3 to 1. So we did make some money. I got to improve these stats, and in a little bit I'll go over some of the mistakes I think I've made. But in the end, yeah, we made money. We're up 9.5% based upon the capital that we put at risk. So here's the monthly performance for June, right? So here the S&P 500, as measured by the SPY, the ETF, was down 9.2%. The Qs, which is the Nasdaq 100, was down 9.7%, and IWM, which is the Russell Small Cap, down 9.2%. So, as I mentioned before, with the money that we had put at risk, we made about 9.6% on the money that we had at risk. Now, to be fair, if I want to compare it to the ETFs, and assuming that you were fully invested in these, I also have to assume that I was fully invested. So even though every month I have my portfolio and I'm rarely 100% exposed to the market, so I do carry cash positions. So assuming that cash position, assuming the entire value of the portfolio, we finished the month up 5.3%. So I want to add this here because I think this is a better comparison to what I'm using here, not so much this. I mean, this is nice to see, but we were up 5.3% on the total portfolio versus what the ETFs did. Now here's the quarterly performance, same thing, right? So for the quarter, this is the April, May, June period. The SPYs were down almost 17%, the Qs were down 23%, IWM down 18%. Now the average money we put at risk every month resulted in a 36% return on our money. But because I'm not fully exposed at all times, and if I include the cash in the account, we finished the quarter up slightly over 20%. And this is the graphic that shows how we've done for the quarter. So basically here's 1, 2, 3 months. You can see here that the portfolio, we've been up every month. So 20.1 versus what you would have made if you had been fully invested in the ETFs. And this 20% again is assuming I'm fully invested, including my cash position. So where did we make the money? It was all on the bear side. Obviously, we're in a bear market. So with the puts that we've done, it was about $151,000 in profits, and then we did the bear put verticals, made about $33,000. I did one bullback spread, that worked out. I collected premium, and then everything else. This bear call spread, this was one trade, and it was a poor trade, and I'll go over that when I'm critiquing myself. Straddles, I didn't make any money. The bull call verticals or the long calls were a disaster. So in the end, I made all the money this month to the downside, and I could have made more, but again, I'm trying to keep this portfolio balanced. So I keep it balanced, so I'm prepared for a rip your face off rally, I'm prepared for a major sell-off, and we try to keep it so that way our gains offset our losses, and that's what we did. You can see here, so this is for the month. I had 22% of the trades long calls. I had 43% of the trades in long puts. I had 17 in bear put verticals, and then I had 12% in bull call verticals. So yeah, so this orange and this blue area right here, let's go Mets. They carried the portfolio this month. Okay, so what could I have done different? Number one, in a bear market, the way we are going long calls is a mistake because the implied volatility is high. I'm paying up for these things that are eventually breaking down. So I'm going to change the strategy. I'm going to try, if I see something that's in an uptrend, we made some money to the upside. We have energy names, metals, healthcare, medical devices. Stuff like that. We did okay on some of the trades. But in this type of market, I think I'm going to stick with the verticals as opposed to just going long calls, because I think that's a losing proposition for where we're at. Going long the puts, it has been working out, even though the implied volatility is very high, but with the market being as violent to the downside as it is, we're making money there. So I might have to just gauge where we are in a market cycle, and then I'll continue to go long the puts, but if I have an inkling to go to the upside to keep the portfolio balanced, I'm probably going to use verticals going forward. Number two, I was experimenting with unusual option activity. I was using the Bloomberg terminal, and I got to tell you, that stuff is spotty. It was hit or miss. Some of them really worked out, but a lot of them are expiring worthless. So there was really no rhyme or reason to the success of it. So just a mental back test. I just don't find a lot of use trading that way. Also, I subscribe to a couple of different newsletters, option newsletters, and they were, touting how good they are at picking option trades. I gotta tell you, most of them, I've been experimenting with 5. I'd say one of them is pretty good. The other one is fairly good, and the others are just hit or miss or just impossible to make money with. So I'll be trimming down my sources of ideas in the next couple of weeks. I mean, in the end, I do the best just looking at the charts. I look at the MACD, I look at the trend, I look at the moving averages, and then I trade accordingly. Relative strength is everything. So I'm just going in favor of the trend. I just need to be more decisive in the type of strategy that I'm using. Like I said, to the upside, to the downside. But in the end, I really can't complain. We finished out the quarter up about 20%. And given, the SPYs are down 17, the IWM is down 18, the NASDAQ, the Qs are down 23. So there's a ton of alpha here, which is fine. I think July I have some work to do because I do have some stuff that's going to expire worthless, so I will be taking losses in July. But hey, we're here. It's the 1st, so I'll get to work and hopefully keep these returns going. So that's my June recap. That's my quarterly recap. I think we're doing okay. I will film a video later on today about the trades that I have on today and stuff that's coming off, options expiration. I'll talk to you later. Enjoy the weekend. Happy 4th of July.